Hey everyone, I wanted to follow up with the last video that I posted regarding the S&P 500 to gold, and I wanted to expand a little bit differently on there on how to use these multiples for your advantage. So in the past video, we looked at the S&P 500 returns, and I've chosen a 20-year hold because that reflects my investment strategy since I have such a long time to go. And reflected in the orange dots right here are the returns over time in relationship to the S&P as a multiple of 1 ounce of gold. Notice how the trend is pretty tight, the residuals are fairly tight, and it tends to increase exponentially once you get below about 1. Well, conversely, the ratio of gold is an inverse relationship to the S&P 500. So typically when you find two assets that have an inverse relationship, we want to include those in a portfolio to decrease the standard deviations or decrease the volatility or increase the Sharpe ratio. So just generally looking right here, once equities get above a 1.5 multiple, the estimated future returns are going to be less than that of gold. Conversely, once it dips below 1.5, the equity premiums are going to be higher than gold. So I asked myself, what if I modeled out the last 40 or 50 years of returns and found the inflection point to where it would have been more advantageous to buy gold or equities at any given point? And so if we come over to this table right here, all I did was make a column. Some of these have been collapsed just because there's so many of them for the calculation, and said, at what multiple would I buy gold at or above where equities would normally be? So notice right here that over this run since 1971 that the equities and gold would have been less than if they would have combined them together strategically. And also notice in the chart right here, particularly maybe 6 years or so after the last recession, that volatility would have decreased as well. So you're asking yourself, well, if neither one were this high, how can they be combined together? Well, it all goes back to buying equities or alternative assets and looking at static pools. And the best valuation indicator that I've seen is multiples to gold. So we used a solver function to calculate what was the highest cumulative yield. So for example, if you only had $100 a month to invest forever, what would be the highest yield given the product distribution? And from this, we were able to have about a $38,000 premium in valuation over just the S&P with less volatility over time. If you went back to the chart that I had previously right here, I'll blow it up. This is one of my portfolios I've been studying, and this is Ray Dalio's all-weather portfolio. Look at the amount of gold that he holds. I won't say it's super substantial, and it's definitely not nowhere 50 to 50 to equities, but I do believe it provides confidence in another asset, and it provides a little bit of hedging against volatility in your portfolio. So keep this in mind when you're looking at investing. Maybe a small piece of your portfolio needs to be invested in gold. It'll help during hard times when equities really drop like a rock, like it has in the last few recessions, to hold value. Right now we're at about 1.74 to 1 ratio. Anytime that dips below there, that should provide an equity premium.
Please like and subscribe.